Fidelity is one of the most trusted names in investing, known for their excellent investment offerings, amazing customer service, and some of the lowest fees in the game. But what if I told you they offer index funds that cost you absolutely nothing to own? In this video, I'll be breaking down the 4 best Fidelity zero-fee index funds that can supercharge your portfolio for maximum growth, all without costing you a single penny in management fees. I will explain what each fund is, which index it tracks or how it's structured, the holdings inside each fund, their historical returns, and most importantly, the pros and cons of each, as we won't pretend any fund is perfect. So sit back, relax, and hit that thumbs up button. Before we go over each fund, you might be asking, what are Fidelity's zero-fee index funds? Let's go over some quick context. So back in 2018, Fidelity introduced a set of zero funds, otherwise known as mutual funds with 0% net expense ratios, aka no management fees taken, for US investors in Fidelity accounts. The idea behind these funds was that by eliminating fees, the funds would deliver slightly better net returns than comparable low-cost funds. These zero funds generally use custom internal indexes or sampling rather than simply licensing a well-known benchmark in order to avoid index licensing costs. And because they are proprietary to Fidelity, these funds have some trade-offs which we'll highlight later in this video. First fund on today's list is FNILX, or Fidelity's Zero Large Cap Index Fund. This is a large cap domestic equity index fund that seeks to replicate the performance of Fidelity's US large cap index, which is designed to reflect the performance of the largest US companies, roughly similar to the S&P 500. As of this video, FNILX currently holds 511 different stocks, with many names you'll recognize, including Nvidia, Microsoft, Apple, Google, and many more. This index fund is market cap weighted, which means each company's weight in the fund is proportional to its market cap. FNILX is also heavily diversified in many different sectors, including information technology, finance, consumer discretionary, healthcare, and many more. Historically, FNILX has provided excellent returns in the past few years, which is great to see. Because FNILX tracks stocks similar to the S&P 500, comparing the performance of FNILX the last 5 years to Fidelity's regular S&P 500 index fund FXAIX, which by the way, I've made many videos about, returns have been extremely similar, as you can see in this graph here. FNILX has many pros and cons, so let's go over those now. Some pros include zero expense ratio, which means no management or administrative fees, which helps returns compound more fully. Second, it's simple large cap exposure. It gives you straightforward access to large US companies, often forming the core equity position for many investors. 3, there's also $0 minimums to invest into the fund, and so this means it's accessible to many investors. And number 4, this fund has strong tracking and liquidity inside Fidelity. Now this fund has only a few cons, but they include number 1, proprietary index means less transparency / standardization compared to well-known benchmarks such as the S&P 500. 2, this fund is not portable, which means that you can't transfer out this fund directly out of Fidelity into another brokerage. You would need to sell first. Number 3, this fund has less small / mid-cap exposure compared to a total market fund, meaning less growth potential in some cycles. Overall, FNILX is a great foundational index fund for investors who are seeking an index fund that tracks the largest US companies, roughly similar to the S&P 500, without paying an expense ratio. In my personal opinion, having a large cap index fund tracking the top 500 US companies is a great way to build a super solid foundation in your investing portfolio for the long term. I always say this, but long-term investing is the most ideal way to see the fruits of your labor with these types of index funds. Next up on the list, we have FZIPX, or the Fidelity Zero Extended Market Index Fund. This fund aims to track the mid plus small cap US segment, or the US stocks that are not considered large cap. In effect, FZIPX is designed to complement a large cap fund by covering smaller and mid cap companies that are not included in the large cap index. This fund currently holds over 2,000 stocks, and because these stocks are small and mid cap stocks, you may or may not recognize them, but some include SOFI, Reddit, and more. FZIPX is also diversified in many different sectors, such as industrials, financials, information technology, and healthcare. FZIPX has also provided solid returns in the past few years as well. Comparing the performance of FZIPX the last year to Fidelity's regular extended market index fund, FSMAX, returns have been fairly similar, as you can see in this graph here. Now, some pros of FZIPX include number 1, it has a zero expense ratio, again, which means no fees eroding your returns. Number 2, this fund gives you a diversification benefit, which means it adds exposure to small and mid caps that large cap funds exclude, which helps broaden your portfolio. Next, this fund is complementary to FNILX. Combining FZIPX with FNILX might more closely emulate a total market exposure. Next, internal sampling allows flexibility to manage risk in smaller names. Next, good potential upside, which means small and mid caps historically can outperform in certain market cycles when risk appetite is high. Now, some cons of FZIPX include number one, there's higher volatility, which means small and mid caps tend to be more volatile, so more risk during downturns. 2. The fund has underperformance risk. In periods favoring large caps, FZIPX may lag behind. 3. This fund has proprietary index/tracking error risk, as with all zero funds. 4. With this fund, there is a trading risk in smaller names, as small and mid-cap stocks can be considered more risky since they are less established compared to large-cap stocks. And number 5, this fund has overlap/redundancy risk. In some cases, FZIPX overlaps with small mid-cap components inside total market funds like FZROX, so your allocations might get redundant. Overall, FZIPX is a great fund for an investor who would like a fund that tracks companies other than large cap stocks. As mentioned earlier, FZIPX is a great complementary fund to hold if you already own the large cap index fund FNILX and would like exposure to mid and small cap stocks. Now, you could also hold an index fund that covers large, mid, and small cap stocks, which brings us to the next index fund on this list, which is FZROX, or the Fidelity Zero Total Market Index Fund. This is a total market exposure index fund covering large, mid, and small caps across all US stocks. This fund uses a proprietary internal total market index constructed by Fidelity themselves. The fund samples broadly from US equities to approximate the performance of the entire US stock market. As of this video, FZROX currently holds over 2,500 different stocks, with its top 10 holdings very similar to FNILX, including Nvidia, Apple, Amazon, Meta, and more. The stocks in this index fund are also market cap weighted. Because FZROX seeks to track the entire stock market, this fund is heavily diversified in most sectors, from information technology to healthcare. Overall returns for FZROX have been excellent historically, which is always a great thing to see as an investor. Now, because FZROX aims to track stocks in the entire US stock market, comparing the performance of FZROX the last 5 years to Fidelity's regular total market index fund, FSKX, which by the way I've made many videos about as well, returns have been extremely similar, as you can see in this graph here. The pros of FZROX include zero expense ratio, which means you get the full benefit of returns with no fee drag. 2. All-in-one simplicity. You don't need to hold separate large cap plus small cap funds, as FZROX gives you broad US market exposure all in one fund. 3 is automatic rebalancing/internal balancing of cap segments. 4, which is diversification across sizes and sectors within the entire US equity market. And number 5 is low tracking error within Fidelity, as you get close alignment to internal benchmarks. Now, FZROX does have a few cons, which include number 1, it uses a proprietary index, as you may not know exactly how Fidelity samples or weighs holdings. Number 2, there's portability/exit risk, as you can't easily take this fund outside of Fidelity without liquidating. Number 3, this fund has vulnerability to mid/small cap stocks slumps, which means that in periods where small and mid cap stocks lag, this fund will underperform large cap only funds. Next, less control over segmentation, which means if you want more tilt towards large cap or growth, you might get constrained by the internal weighing Fidelity chooses. Overall, FZROX is a great index fund for an investor who would like exposure to the entire US stock market, including mid cap and small cap stocks, without paying for an expense ratio at all. In my personal opinion, having a total stock market index fund is also another great option for your foundational investment in your portfolio, simply because you are betting on the entire US market going up over the long-term horizon, which means that you'll be heavily diversified, and this will include gains that come from mid and small cap stocks. The next fund on the list is FZILX, or the Fidelity Zero International Index Fund. Like the name suggests, this fund offers exposure to non-US stocks, including developed and emerging markets outside the US. It tracks a proprietary international index designed to replicate global non-US stock performance without using costly external benchmark licensing. Thus, FZILX gives you international diversification, which can be complementary to US stocks. FZILX currently holds over 2,100 different stocks, with some international names that you will probably recognize, including Samsung, Taiwan Semiconductors, Alibaba, and Toyota. Since this fund seeks to track international stocks, it's also very well diversified sector-wise, with top sectors being financials, industrials, and information technology. Returns for FZILX have been spectacular in the past year and have been solid the other few years of the fund. Comparing the performance of FZILX the last year to Fidelity's regular international index fund FSPSX, returns have been fairly similar, as you can see in the graph here. Now, some pros of FZILX include zero expense ratio, which means you get no fees dragging overseas performance. 2, you get international diversification, which helps reduce reliance on US equity performance and gives exposure to different economic cycles. Number 3, this fund gives you broad global coverage, which includes developed and emerging markets, giving exposures beyond just major developed nations. Number 4, this fund complements US holdings, which means building a global equity portfolio is easier using FZROX plus FZILX, for example. This fund has some cons, including number 1, there's currency/geopolitical risk, as international investment introduces additional risks such as currency fluctuations. Number 2, there's less liquidity/increased tracking error, as some foreign holdings may be less liquid or harder to sample well. Number 3, performance drag in the US dominant cycles, as if US equities outperform, international funds may lag behind. And number 4, potential overlap with existing or future international ETFs, as if you already hold international ETFs, duplicative exposure may occur. So now that you know about these index funds, how should you use them? Here's some ideas for you to consider. If you're an investor that wants a one-fund solution for the entire US stock market, FZROX may be a good choice for you. If you prefer to customize large caps versus small caps, FNILX and FZIPX may be a good fit for you. If you want an index fund with international exposure, FZILX may be a good fund for you. If you want to build a global portfolio, combining FZROX and FZILX in a 70/30 or 60/40 split may not be a bad idea. Now, at the end of the day, Fidelity's zero-fee index funds offer a rare combination of simplicity, broad exposure, and no fees. But always remember that zero fees do not mean zero risk. Now, don't get me wrong, these funds are great tools to help you build your wealth, but they're not perfect. Always do your research, check updated performance, and make sure each fund fits your long-term investing goals. I hope you learned a lot through this video, and I thank you so much for watching. If you're new here, my name is Paul, and I talk all things investing, personal finance, and money. So if you enjoyed today's video, make sure you smash that like button and subscribe, as it helps me out so much at no cost to you. Your life is a masterpiece, so let's unlock your full financial potential together. Make sure you check out some of my other videos, and I will catch you in the next one. Take care.